Trading support and resistance levels is a pretty common approach to trading. And whether it's a viable strategy or not, that's another question. And much of that's going to depend on the trader. And one of the biggest issues with support and resistance is defining the levels that actually mean something. So how do you know that your support or resistance lines are any better than a random line? So if you turn off all the bars or candles on your screens, I want you to toss up some horizontal lines, turn the bars back on, you'd probably see that price has miraculously bounced from the lines that you have drawn. To add to that, many traders are aware of the different basic ways a market can respond to a technical level. They often are not taking it into account when they're executing around that level. A market does not have to just bounce from a level, and that's a really dangerous way of thinking that's really easy to get sucked into. And a market can breach a level only to turn around and reverse back from where it came from. A technical level of support and resistance is just a reference point for subsequent activity. And this must be at the forefront of a trader's mind when looking for clues to take their next trade. So I'm not going to cover how to identify what levels to use, but using the structure of price is a pretty decent start. So what is rotation and does it matter? Now, before we get into how a market can respond to a level, it's really crucial to cover rotations. And a rotation is just a definable leg within the market movement. It doesn't have to be a big directional swing. Just think of it in terms of breathing. A market must, just as a living creature, breathe in, breathe out. In a bigger directional move, there are still counter rotations to that move. And you could think of these in terms of breathing out, the expulsion of stale air or market energy, and readying for the next intake of breath to fuel the next rotation in the direction of the bigger move. Now, the key point is that it's always happening. And by identifying the size of the last swing, you can get a better feel for whether enough energy has been expanded in order to encourage the other side to push the market in the opposite direction, at least by enough for what you consider to be a small rotation. The rotation concept is important when you think of trading a pullback. The market's breathe in should result in a gentle exhale. The breathe in should show that another breath, another impulse move, is deserved as long as the expulsion of air, the pullback, is not severe. The size and the distribution of rotations is highly dependent on the product and the time frame you're looking at. And to extract this kind of information from the markets you're looking to trade, it's far easier if you have the kind of software that does most of the work for you. And if not, you can select a period and just do it manually. And you can even use the Fibonacci extension tool to measure both the impulse and their corrective declines. So what you're going to end up with is a distribution and what has been the most common size rotation over the period that you're analyzing. So by tailoring the time frame that you trade and the general scale out size to take the market's rotation profile into account, you can actually get to a point where your trades have a much greater probability of becoming safe, even if they don't end up being big winners. Put that another way, understanding rotation can help you get in sync with the market flow so you don't enter a trade just when the market is tipping its hand that a pause is coming. The price doesn't always bounce from support and resistance. So we have some basics about rotations as a foundation. Now let's look at the ways the market can actually react to these levels. Price can just bounce off or a tick or two before the level itself, really. Like in all cases, a market can bounce with a counter rotation of sufficient size. However, before the counter rotation is sufficient in size, it looks like this. So at this point, the market can continue up and form a decent bounce, or it can continue to move lower, but at the same time be moving back and forth by a handful of ticks each time it does that. So at this point, it's a little premature to make an assumption based on the information the market's giving you. There's too much that can happen at this point. So once the market has moved a full rotation, however, the chances of pulling back to the level and then at least attempting a secondary push in the same direction are much higher. Secondly, price can just slice right through the level. And for a greater chance of the break to at least have a secondary push after pulling back or somewhere towards that level, the simple requirement is that the break is by a number of ticks that by studying the market has been identified as a common size for a rotation. And also keep in mind that if price does slice through a level, it could just keep on going. Now here, price can just breach the level and then bounce back. The textbook version of trading support and resistance is not really accurate. It's common for price to slice through an area without invalidating the level of interest. So if you think about traders who play the small bounce shown earlier, where do they place their stop loss? Right below the swing. So the market seeks order flow and it takes out stops and then continues in the intended direction. So you want to ensure that your stop is set in an area that allows for some degree of randomness of price. Now there's many different combinations the market can throw at us. The market does not have to do anything, but we're not expecting certainty. All we're after is a decent probability to lean on. And a market can look like it's already reacted to a level in a certain way. It might look like it's bounced, for example, only to run through the level on a retest. It might look like it broke the level, but it's really just trapping the sellers in this example. And the key thing is to get your timing right. And to do this, you can leverage your understanding of rotations. If a market bounces from or breaks through a level by a decent number of ticks, what it's telling you is that it's had enough energy on that side to gain that reaction. And at least an additional secondary test in that direction is likely after any pullback. It might continue to reverse or just keep going lower. In fact, it might never give you a decent pullback at all once you've spotted how it is initially behaving. But until you see how the market reacts, it's really difficult to judge the nature of other traders and what they want to do at this level. So there's 2 steps: identify and consider. And I always believe in the importance of identifying key technical levels of support and resistance. But without considering how a market can react once it gets there, you're at risk of making an error in assuming that it will do one of 2 things. It'll either bounce after pulling back from the level by just a handful of ticks, or make a big move on a breakout just because the price has traded through by a tick or 2. Understanding rotation and market energy is another part of unlocking the power of levels. Get that right, and you'll potentially improve your timing of trades significantly.